What it does, good people. Hope you guys are well. Hope you guys are good. Hope you guys are well rested for this coming week in the markets. So far, so good. Took a few trades myself. But nevertheless, we're not here for that, guys. I'm here with another video whereby I'll be educating you guys. I'll be dropping one of the most crucial instrument in trading, which might also improve your win rate, also improve your edge, might also improve the current strategy, whichever strategy you're using, or if it's one of the strategy I taught you on my previous videos, or those in my mentorship, those I've given multiple strategies or helped curated their own strategies. This is gonna pretty much be that bright light in your aha moment. So, what I want us to do is go through it. So today, guys, I'll be giving you the ins and out of daily bias. What is a daily bias and how to um get the daily bias. So the daily bias basically, guys, is knowing which side of the curve or the market we are on today. So basically understanding what we're looking to gun for, what we're looking to do for the day. And yes, of course, not always you're going to be accurate, but this will insanely improve how you look at the charts, and it will give you many ways to look at the market and go about it. So how to get the daily bias. So first of all, before I get into how to getting your daily bias for the day, knowing what you're looking to do for the day and all that, um, we need to understand one thing, price action. We need to understand price action and how the market moves itself. So we all know the market moves from internal liquidity to external liquidity. What's your internal liquidity? Your internal liquidity is your fair value gaps and your opening gaps and other gaps as well. That's your internal liquidity. And then what's your external liquidity? Your external liquidity is your swing high points and it's your swing low points. So for those of you who don't know what's a fair value gap, I'm gonna break down a fair value gap for you here. So a fair value gap is formed by a three pattern candlestick formation whereby the middle candle is expensive, meaning there was a gap in it. So once that gap in it is left, you look from the wick to the last candle's wick. Remember, it's a three candlestick formation pattern. It's one, and then the middle one must have the gap, and then the upper one must not cover this gap, and then close as well. So now we have a bullish FVG. So this is going to be our gap. This is where we'll be anticipating the market will most likely rally into, and then once it rallies into here, it bounces back. That's what we'll be looking for, right? And then a bearish fair value gap in a selling position whereby a bearish fair value gap, it's a three candlestick formation as well, whereby the candle as well expensive, and then the gap in here. So here it's where we're expecting the market will come back into the zone, and then from this zone push back down, right? So this is a bearish fair value gap. And I'll show you how. So, and then now external liquidity. What is external liquidity? Your external liquidity is your swing high and your swing low points, right? Swing high and your swing low points. So what's your swing high and what's your swing low? So your swing low is basically um a 10 point whereby the market is looking to not reverse but either to make create a low or potentially reverse at this point, whereby a three candlestick formation pattern as well, whereby the middle candle does not, I mean, the side candles do not overlap with the middle candle. You see, the middle candle is the only one that's done, and the previous one is a bit high, and the last one is also a bit high. So we call that a swing low. That's a point in the market where we might want to mark and say, this is our low. Swing high, same thing as well, vice versa. So the middle candle is the upper one, and these two don't overlap with it or don't surpass it. So this is what we'll mark also as our swing high point. How now does the market move from these points to these points? So as we know, this is how the market moves, right? So this is how the market normally moves. The market moves, just looking for the tool to draw how it normally moves. So the market moves creating higher highs, higher lows, higher highs, higher lows. high highs. These are the patterns you see. This is pure price action, right? And what's resting in these highs? Right? What's resting in these highs and what's resting in these lows, right? This is a swing high, right? This is a swing, I mean low. This is a swing high. This is a swing low. This is a swing high and this is a swing low. And what's that? External liquidity, right? Because there's liquidity where in these higher points and these lower points, higher points and these higher points. This is what I broke down to you, the external liquidity, right? And then as the market moves higher, high, and lower high, 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 and lower high, in the middle here, it's just I'm drawing it in a line graph. These candlesticks are gonna form. If we're pushing up, you're gonna see can if we're pushing up from this swing low up there, you're gonna see these candlesticks. Some of them won't have fair value gaps, some will have fair value gaps. So meaning now in an instance whereby we have um we are bullish here. Let me just change this. You see, let's say we just created this low here, and then we are moving up, right? As we move up, we create this fair value gap, right? And from this swing low, where were we moving to? We're moving up. What were we targeting? We were targeting this swing high point. That's how the market moves, the swing high point, right? Then after targeting this swing high point, what happens? We leave a fair value gap, right? So now once we leave this fair value gap, what are we expecting now? Because the market has already targeted this swing high and we don't have a new swing high yet because the market is still pushing up. What are we looking the market to target to if it does reverse? We're looking for the market to come back from this point here, this zone, which is the fair value gap. And once it comes back to this zone of the fair value gap, what would it have created up here? A swing high point, right? It would have created now a new swing high point right here. How will the swing high probably look? It will look something like um, it will look something like this, right? Because it turned. And once it turned swing high, it goes back down. Where is it going? To the FVG. If it respects this FVG and 10 from this point, where will it be targeting? That new swing high, as long as we're in an uptrend. So this is an example of an uptrend. So the market always moves from internal to external, internal to external, internal to external. This is an example of an uptrend. And then if in a downtrend, it's vice versa, guys. In a downtrend, it's vice versa. So now that I've broken down to you how the market moves and all that, so we're going to get into understanding the daily bias. So how I go about looking for my daily bias understanding. So this is my FX replay. Basically, I'm in the middle of nowhere. Basically 27th of February. So we're gonna try and see if the market does what we say it's gonna do every day. So first of all, I want us to notice where's our swing high. Let's mark our zones where the market is looking swing high, and we don't have a swing low. So this was our last swing low here, here, which just got taken out, right? Which just got taken out. The market moved there, which goes, and then in the middle of that, what do we have? We have our FVG, our bearish FVGs, our internal liquidity, right? And here's one thing I don't like people say, because some misconfuse it. They like saying, oh, once you get to a zone, a liquidity zone, you must reverse. No. Once you get to the liquidity zone, doesn't mean you must immediately reverse. The market can just still continue its way. You need confirmations on a lower time frame, but there's high probabilities of the market reversing. So if we do reverse in this swing high here that I marked, where will we be looking to react to? In this FVG here, right? This is where we might be looking to react to. So let's see if we do move up. So look, this is the another day. And this other day, when the market closes again, what do we create here? An FVG again, right? So we might also react from this FVG and target. So in the day, so if the candlestick, this is, let's say this is Tuesday. So in Tuesday, what we might be potentially looking for is reversals in this area to go to the downside because the market is showing movement to the downside, right? From internal to external. right? Let's see if we do respect that zone. We do respect that zone, we push down and we push down to this liquidity zone, right? And then the following day again, what's our bias now? So we knew this day that we might be looking for a selling reversal. We're still in this low again. So there's things that might happen. We might reverse in this zone to go target those internal liquidity zones there or push lower again. So I want you to stay till the end of this video whereby I'll be dropping extra added information on how to accurately boost your daily bias win rate with this as well. So let's see now. So this is the day. So on this day, look what's happening now, right? So on this day, we're still bearish, but to where to we don't know yet because we're still waiting for liquidity zones to form. Look what I want you to look here. So on this day, what do we have? A swing low. So we're now gonna move from this swing. This is our new intended low, right? So since the momentum we see we are bearish overall, we are most likely to go come target this swing low. How do I confirm this as a swing low? Remember that three candlestick pattern I told you guys about? Look at this. These two candlesticks do not overlap this middle one, right? So this verify this to be a swing low point, right? So now that we have that, let's see, what do we push? We push to that day. So the bias was right. We went into that day. See what happened next. We're still bearish until proven otherwise. So we break the zone. Um, sorry. We break the swing low. So we keep on pushing downside. The bias is still bearish, right? So what do we do now? We create an FVG again to the downside. So already taken out external liquidity. Which other liquidity might we gone to? This one here, right? This one here. This might be our liquidity we want to go to and react at this point. So on this day when the market here, you can have two options. You can either wait till we get here and sell or be bullish towards the liquidity. So in some instances whereby let's say maybe it's my trading times, let's say it's like um so this is not my trade, but let's say like it's like 8:30 New York time and the market is still here. My bias, depending on the smaller time frame confirmation, might be I'm bullish. Why am I bullish? Because I'm targeting this zone. So, because remember, this is a daily chart, guys. So on a smaller time frame, there's a lot of data happening here. So if I go to my 15-minute, this is what's happening. You see, there's too much information whereby you can trade with it, right? But the daily, it's what I use to gauge the bias. So I might be bullish towards my liquidity zone, or rather wait, depending on your strategy. That, like I said, this is gonna boost whatever strategy you're using. So, or rather wait till I get in this FVG, look for confirmations of a reversal, and then push to the downside. And if we do close above, we would have created, if this candle does close maybe here for the day or in this formation, we would have a swing point here and then would be pushing here internal to target external, internal to external. Remember what I told you? Internal to external. So let's see what happens. We target internal, we into the internal now, and then from internal, we push down, right? So as you guys can see, we pushed down, then we're still in this zone here, pretty much respecting this internal liquidity. Expecting it, but we seem to be like closing it. And then in instances like this, you see, okay, we didn't respect, but on certain days we could have, if you were a scalper, you would have gotten nice entries here because this area here was respected, right? So let's see if we still have fair value gaps to attend to. This has been mitigated. So I don't like utilizing mitigated fair value gap this low as well. So always make sure you clean your charts. Um, this was respected, mitigated. So if we don't respect these ones, so if we're bearish on a smaller time frame, which is most of the time 1 hour, 4 hour, in this instance, we see here we're consolidating, right? In this instance, if we're bearish, how would I know where we're targeting? I'd look where's the nearby liquidity and the trend. Overall trend is bearish. So even though there's no fair value gap, I still consider my trend bearish, depending on what the 1 hour tells me or the 4 hour tells me. So the 1 hour is kind of telling me like we're changing direction to the upside. Let me see the 4 hour. 4 hour as well, we're breaking structures to the upside. So which might indicate to me that liquidities we're targeting might be these ones here, right? These ones here, internal liquidities. If not, we're going to the external. So we look and see what happens. So basically, the simulation is over. I don't know what I did 1 month. I should have done an extra 2 months or something. But basically, this is how you gauge. So I'm gonna show you another trick. So I'm not. Let me just open one of these sessions, and just go to the daily as well to continue breaking down. So look at this. So let's continue where we left off, right? So this is a new chart, but same ideology, right? So this is a daily chart. Um, swing high, swing low. We have FV internal liquidity, which is the FVGs. There we go. Here and here. So bias here, what's the bias? Obviously, we might react here and push to target the external liquidity, right? Or we can be bearish up until this. So this is vice versa. It's like, for example, if this, because remember, the daily time frame alone can't tell you we are selling. You need confirmation on lower time frame. So if, for example, let me quickly make create a setup here for you guys. If, for example, look, we have something like this. Where's these pencils? So if now, for example, the bias is once we get to the FVG, you might see a potential reversal to the upside. I'm not gonna take a buy same time because I'm here or anticipate my day is bullish same time we're here because the bias says the bias is just to guide you what you're looking at by understanding how the market moves. So I have two options whereby I might be looking to push up, but at the same time, it doesn't mean I must only be looking for buys. If the market is still saying I'm bearish, I can still trade my setup up until I cover both these fair value gaps. Or if I violate them, I know I'll be going to this zone here from internal to external, whether we violate or not. So I'll be looking now. Let me just quickly go to my 1 hour to confirm my trade. Let me see if I can get a trade here. Um, we are here. It's 12 in the fair value gap. So what I want to see in my 1 hour, it's a change of direction or to the opposite side. Then my trade will be confirmed. So let's just do this. Do we break structure to the upside? We're in the daily FVG. Not yet, not yet. You see, we're still pushing to the downside. So in this instance, because the price action was bearish, I could have entered sells here targeting these liquidity zones because I know we're going there. They are a draw on liquidity, right? So the following day, we're in the following day now. Let's see if we do respect. So the following day, we do because we broke structure here. So if we broke structure here, whatever entry model you see, whether you have a setup, me, I'll be looking for the ICT mentorship 2022 models most of the time. Then this will be my entry fair value gap. That's if you also trade on a 1 hour. I don't. I have to refine it on a smaller time frame. Then let's see if we respect it. We're in it now. This, let me just change its color so that it's different. So we're in this fair value gap. In this fair value gap. In this fair value gap. I want to see a displacement. So this is a displacement. This is where I'd probably enter my buys, stop loss just underneath here. Target the 1 is to 2. 1 is to 2, or target these highs as well. This is where I'll probably take my partials. So let's play it out and see what happens. Does it take us in? In fact, it takes us out. I was looking for a re-entry. My re-entry will be somewhere here. I need to be somewhere here. Stop loss was too tight. Okay, this is not a trading time. It's 10 o'clock, so I wouldn't be executing trades at this time, although I'm anticipating a reversal at this zone. So, but overall, we do see what price action does. We end up pushing to the upside. We end up pushing to the upside, right? So you see, bias-wise, I was right, right? So we end up pushing to the upside, and there we go up there. So bias-wise, you could tell that we're looking to go to the upside. Looking to go to the upside. So this was a rough trade. This is not how I exactly trade, guys, but it's how that's how easy it is for me to read price action, because I trade the orb and the silver bullet at the moment. But this is how easy it is to read price reaction wise. So here, if I was planning this trade properly, I would have adjusted my stop losses accordingly, proper 1 is to 2 RR, and executed a perfect entry. But we see what happened here. We see what happened here. Price respected and pushed to the upside, the daily fair value gap, because we understood the bias, right? We understood the bias. So um, just remove these. Movies. So now that we know, where's our next drawn liquidity? This swing high. This swing high or this bearish FVG here. So if we're buying, that will be our next drawn liquidity whereby we'll be looking to reverse from or react on. Let's do this. So because we're bullish, we're gunning for this swing high. So this is where, so then now price action on a smaller time frame will always tell you if we're still bullish, it means we won't respect that fair value gap. So look at this, then we see now our target. There we go. Do we reverse from here or do we create a new swing? So you see, a new fair value gap was formed. We're anticipating us to respect this zone. Do we respect it? Yes, we respect it and push away from it. So in a nutshell, guys, that's how you go about looking for your daily bias. You can go do it over and over and backtest. The market always moves from external to internal to internal. And you use that, and you can use that to your advantage and gauge your daily bias, improving your win rate or bettering your trading strategy. So I said, if you stay till the end of this video, I have extra tips that you can use to gauge daily bias. So daily candles. This is a daily candle, right? So each and every green, red bar, it's a candlestick. It's called a candlestick. So how I use it to gauge also my daily bias, I look at the three candlestick formation pattern. If Monday, let's say this was Monday, if Monday closed like this, and then Tuesday closes above Monday, right? Tuesday, this is Tuesday, right? Tuesday closes above Monday. My anticipation for Wednesday is that it's gonna also close above Tuesday, which for me it's a bias also to say, meaning Wednesday we're gonna be bullish because yesterday we closed above the Monday candlestick. Unless if now we close the following day. So let's say now Wednesday closes above as well. What's our anticipating is that Thursday is also gonna push up, right? So our bias is gonna be bullish. Unless if it closes below. That if it closes below, what I do, I don't immediately anticipate that we are moving down. I need to see two candlesticks. This one, if it closes below, I need to see the following day, which is why what I call my waiting period days now. So my waiting period days is whereby I'm looking to see what today is going to happen to determine tomorrow. So if today as I anticipate was going to bullish, it doesn't become like bullish, right? If it doesn't become bullish, what I anticipate is that what I anticipate is that what I anticipate is that if we don't become bullish, right? What I anticipate is that the following day must prove to me that we're really bearish. So if it closes like this, then I know the following day candlestick as well is going to be bearish unless otherwise. But if this one, even though this one closes in the bearish, comes back up like this, I'm still in a bullish formation. If it doesn't close above, it just keeps on closing like this. All we know is that we'll be in a consolidating market. So I don't trade consolidating market. Let's back test that and see. So look here, right? We closed above this day, and this is today. We're anticipating we're going to close above this day, right? What do we do? So bias is bullish. We don't close above this day, right? So I won't immediately say we are bearish now. We are selling. No, I want to see the second day, right? So now this day also closed below. So now I'm anticipating this is going to be a bearish day. And now you use it hand in hand with what I told you and how the market moves. You look at this fair value gap, you're like, okay, our bearish day might be short. We might be bearish to this fair value gap, and then we might reverse day. So it's giving you time to narrate your um, take profits, or your, where you're looking to enter or exit and all those things. So we look, we see, then we don't come into this FVG. Look, we close above this, right? But I want to see how the day closes, but we know we're bullish, otherwise we don't. So this is what we call a consolidating day. So this zones here, this was consolidating. So we come back into this. Let's see what happens. We respected this FVG, right? We're moving away. So we closed above. So I want to see the next day close above as well. This one. Then I'll know we have a bullish day. We do what? Close above. So now I know the market today, we must close above this candlestick, right? Let's see what happens. So we failed to close above. So this is also a way to gauge. So we're in a consolidating format now because we're failing to close above or either below. So it's good on a trending market. So we close above, telling us it's still a bullish day. And the formation as well, we must close above this one. This one, because we close above, this one must close above this one. So we're still bullish for the day. Again, we're bullish for the day. We must close above this one. So we fail to close above. What does it tell us? We're not bearish. No. There's an FVG here. I told you, trend must be, you must be told by the 4 hour, the 1 hour. This is just to gauge direction. So now we disrespected this bullish FVG and we closed below. So also telling me that chances are we might anticipate closing below this for the day, bearish wise. We don't, we're in a consolidating format. So how you use this is hand in hand with your price action. So you see, if we said we were bearish and then you get a change of direction to the upside, it changes your narrative. That's why I always tell people, don't fall in love with your bias. Your bias is just there to help you gauge. We were bearish, but when we broke structure, we are looking at an uptrend unless if we break structure to a different side, right? So bullish, bullish, then we close above. We fail to close above. It does not tell us that we are bearish. Okay, we change character, so we might be bearish. Bearish to where? A swing point. Do you see? This is a swing low. Swing low. If you see how we created this candlestick and that one don't overlap. So we might be bearish to that swing low. We enter to the swing low. So basically, guys, this is how you gauge your daily bias. So it's very easy. Use that. Trust me, your trading will be perfect. But otherwise, thank you guys for tuning in. Catch you on the next video. Cheers.